Welcome, everyone, to the 2024 Financial Literacy Conference, Day 4, Session 2. We are excited to welcome you here to this specific session. And before we introduce you to our speaker today, I do want to share a couple announcements. So first, thank you to our gold partners, Abbott, U.S. Marine Corps, Royal Industrial Solutions, Insight Global, and Enterprise Mobility, and our silver partners, Aldi, Lisi Aerospace, Central Intelligence Agency, Cornerstone Research, eBus Charge, Rakuten, U.S. Army Medical Recruiting, and Wells Fargo. And finally, I do want to share our summer experience survey and first destination survey. So if you are a first, second, or third year returning in fall 2024, we want to encourage you all to fill out the survey because we want to know what you are up to this summer. If you're taking on an internship, studying abroad, or even if you are looking for an internship, we do want to assist you in this process, and our advisors are ready to meet you. So please fill out the survey by scanning the QR code. And once you complete the survey, you will have a chance to win a $75 Amazon gift card. And same for graduate students, or students who are graduating, I should say, in class of 2024. You get to fill out the first destination survey. And once you complete the survey, you have a chance to win a $50 to $100 gift card of your choice or Apple AirPod Pros. So please fill out the survey, and we will leave this up here for about 3 to 4 seconds so that you all can scan the QR codes. All right, so now I would like to introduce our speaker, Ryan. He's a returning speaker. If you joined our session, our late night SC session, you might recognize him. If you joined our session last year, you might recognize him as well. But he's the Director of Business Development at the USC Credit Union. With more than 15 years of financial services industry experience, Ryan assists our chosen family with a focus on student outreach. And his expertise provides members with financial empowerment education to equip them with necessary skills, knowledge, and confidence to achieve lifelong financial success. So thank you, Ryan, for coming back, and the floor is yours.
Fantastic. Thank you so much, Sarah. And thank you to the Career Center for having me here. Just great to be here and share some fantastic information, specifically today, part of our Discover Your Financial Potential series, and specifically focusing on mastering your credit score. So we're going to go through some great information today for you and provide you really 5 great tips which will help you improve your credit score over time. So for today's agenda, we're going to be reviewing the importance of credit because this is something that really we need to focus on through our entire lifelong journey here. We're going to focus on the reason why we truly need to understand credit. I'll provide you with 5 great tips for improving your credit score. Then also some great information in what you can do to protect your credit and as well access your credit report. So really giving you all the information that you need to do to fully be aware about credit and really put you in the driver's seat and in control of just this important information here, which really is going to follow you in regards to all aspects of your life going forward here. So let's jump into it right away and focus on the importance of credit. Really, why is credit important out there? There's so many factors in which it's coming into play these days. I'm just seeing it really touching every piece of our life here. So pretty much anytime we're requiring financing, getting a loan when we need it, credit is one of the key determining factors in regards to that qualification process when you submit an application. Credit is really determining your kind of approval, as well as, most importantly, the interest rate that you're going to receive on those loans. And we want to make sure that we have the ability to afford those loans at a great low interest rates. And that's why credit is so important there. Anytime we're renting or buying a place, credit is a key feature of that. Basically, if you're looking at renting, anytime you enter into a lease agreement, your credit is being checked because the landlords want to determine your financial responsibilities and your risk in regards to paying those monthly bills on time. So really important. Renters are looking at that. Anytime you're buying a home, obviously, that's a home loan application, and your credit is such an important factor in there. Our third bucket is employers, and working here with the Career Center, noting, anytime basically you're applying for a job, and basically when I applied here at USC, my employer requested my authorization to pull credit and to review that because they wanted to see that I was financially, fiscally responsible myself, and because that was going to be a large part of my role. Um, and basically the duties that I have here for the USC Credit Union. So employers are checking credit, and that's extremely important that we have that established and built while we're all going to school. So basically, once you graduate, that you have a full established credit report and starting to continue to strengthen that over time, and that your employers are seeing that. And then lastly, any utility and insurance companies are checking credit as well, as that kind of follows into their pricing programs there. So really the importance of credit is following us in regards to all aspects of life. So we really want to make sure that we understand it and understand how to build, strengthen, and secure it across the board, which is what we're going to be talking about today. So just kind of jumping in, giving us a quick example in regards to a home loan here of $30,000 on a 30-year fixed rate. We have two, basically, we'll call them new graduates out in the marketplace. They've just gotten their jobs. They're looking now to purchase a home. We have Diego and Angela. Well, just noting the difference in regards to their credit score here and what that difference in the interest rate is, and then really what the impact is on the overall dollar expense and that interest rate cost over time. So just a difference in regards to these two credit scores of 660 to 750. We're seeing quite a bit of a difference in regard to the rate, at least a difference of zero point 0.6, going from 3.88 all the way down to 3.26. We see that directly reflected in the monthly payment. We're not seeing a tremendous difference in regards to that, but really where this comes over, and specifically over time of the entire term of this loan, is the interest rate charge there. And the difference in that, as we see over an entire 30-year period of just having that higher credit score and that impact of that on a mortgage over a 30-year term, is a savings that Angela is able to make of over $37,000. So truly important that we have basically the best credit score possible, and that our real focus is kind of above 740, 750 plus. Getting into that range really provides your best rates across the board, and really then provides you that affordability with a lower monthly payment, and most importantly, a lower charge of interest over time. In this example, we're seeing that savings of up to $37,000. So extremely important for the affordability of the loans when we're going to need them, because it's not a matter of just when or if. We will require them in order to make those purchases that we want to fulfill our hopes and dreams of down the road here. So when we take a look at kind of understanding our credit score, we really have kind of 5 tiers in regards to the number here. Basically, your credit score is really just a risk rating, which helps us as a financial institution through banks and credit unions determine you as a risk when applying for a loan, and how we're going to treat that risk in regards to the interest rate and the approval of the loan limits, and pretty much the entire qualification and approval itself. So we range all the way from poor in regards to your credit score all the way up to exceptional. And really starting out kind of with no credit right off the bat, you kind of start at zero, and then you kind of jump into the fair and good categories once you establish and build credit. And then, over time, and this is something that it can be done within a month, 2 months, 1 year, 3 years. This is really a full lifelong journey of continuing to build and strengthen your credit over time as more credit facilities come on board through you with you during different life cycle stages of your life. So basically, we want to get in that fair category right away, build up to good, get into very good, and then just continuing throughout our lives, continue with that very good, and then hopefully finally achieving that exceptional category. But as I noted, really we're focused on just getting into that very good bucket because basically best rates start at about 740 plus, and then we just want to make sure that we're maintaining that across the board there. So here's basically an understanding of your credit score and what that credit score breakdown is. There's 3 credit bureaus in the country. We have Experian, Equifax, and TransUnion, and each of them determine your credit score a little bit differently, and you would see a variation of your credit score through all three credit bureaus here, but they're basically utilizing the same criteria, just sometimes a little bit different math to develop what that final number is going to be. But all three of them are focused on these 5 buckets that we have: payment history, amounts owed, length of credit history, types of credit, and new credit. And basically, these are the key items in which we want to focus on really through our entire life here in order to build and strengthen that credit. And I'm just going to point out the two first ones right off the bat as students here going to USC and kind of starting, our life journeys here in regards to graduation, starting employment here. These are the two items that we want to focus on right off the bat. And then the other three are then going to just work out and follow us as we continue basically our journey. So number one, making sure that we have our payment history taken care of. We're basically making all of our payments on time. The second one is basically utilization, the amount owed on your credit card. So these are the two most important factors which you can utilize while you're going to school here in early life to really strengthen your credit score across the board. Payment history, just making our payments on time. The second one, amounts owed in regards to that available credit, really is the utilization of credit. How much are you using it? How much are you dependent on? And we're going to talk about specific features, what you can do in the next couple slides here. So let's jump into kind of my 5 key points here in which we can utilize to strengthen our credit score. First one, make our payments on time. Sounds easy enough, but there's so much going on in life these days, it can be easily forgotten. So some of the key steps that we want to do right off the bat is, make it easy on ourselves. Set up auto payments so that we don't need to think about things. We have them automated right off the bat. This is truly the most important component of your credit score because really that credit report is just a transaction record. Over time, we're looking for the longest timeline possible in regards to assessing that risk and making sure your payments have been on time. And really want to point out here to everybody, just making one 30-day late payment and your credit report is going to note a 30-day late payment, a 60-day late payment, and a 90-day late payment. And that will stay on your credit report for a number of years if you do have one of those that fall into a category. And just one 30-day late payment can drop your credit report by more than 80 points. And it will take you approximately up to 2 years of perfect repayment after that to get those points back and to continue strengthening your credit. So it's so important just off the basis of just making those payments on time. A couple days late isn't going to be a problem, but you really don't want to get in that pattern. That's why I really suggest in making sure that you set up auto payments there across the board so you're really in control of this stuff. And then, going forward, if you do run into payment problems, make sure you contact your financial institution right away and work with them on that to avoid any reporting of a 30-day late payment, or as well, they may be able to provide you with a solution that gets you out of this, late payment cycle and puts you on a better path there. So number one, always focused on making our payments on time, making sure that we're not getting a 30-day, 60-day, or 90-day late payment on our credit report. Number two here is keeping our credit card balances low. That's the utilization on that card. How much are we using? So on our credit card, we want to specifically note right off the bat, what is our credit limit? And we want to basically have a utilization of about 30% or less. So basically, as an example, if our credit card limit is $1,000, when our statement is produced and sent to us, we want to kind of have an outstanding balance of about $300 on that statement, and then basically make the full payment in full to pay off that outstanding debt. This is important because basically at the end of every month, when your statement is produced and that outstanding balance is produced on your statement, that outstanding balance is being submitted to the credit bureaus and put on your credit report. So when I see your credit report, I see what your limit is. I see what the outstanding balance was at the time when your statement was produced. So really important is if you can get that within kind of a 30% utilization limit there, and then basically pay it off in full before that statement is due, you're going to be in a really great position to strengthen your credit over time. And as I noted, basically the first two steps are the most important steps that we want to focus on. And then the next three that we're going to discuss are really going to kind of follow suit from there. So make sure you have a plan to pay that balance down. You making sure that you're utilizing your budgeting and making sure you're on top of your budgeting to make sure that that outstanding balance on your statement and on your credit card is being paid in full. If you can't make your payment in full, you definitely want to make the minimum payment possible. But note, you really want to try to make more than that minimum payment. Those minimum payments are there to provide you, great flexibility. But with great flexibility comes a very high interest rate cost on credit cards. And you have to know your typical interest rate on a credit card is about 23%. And credit cards can really range anywhere that I've seen rates as low as 15% all the way up to 30%. And that is a huge amount of interest being placed on those outstanding balances there. So really make sure that you have a plan to pay that down and that you're not using the accounts and trying to pay them down. So basically, really, if you're in a position, put your credit card away for a couple days, for a week, in regards utilizing your debit card, utilizing cash. It's very easy. Just yesterday being on campus, I probably used my credit card about 3 or 4 times during the day and really had no idea until the end of the day, until I went on online banking and determined, what I had actually spent, because I'm just not getting the receipts out there. It's additional paper, not even reading them there. So really take note of kind of where that spending is going and working with your budget to keep that utilization and those balances low. So our third step here that we want to consider over time is basically reviewing any accounts that we want to close. This is really important here and will help improve the length of your credit score, because anytime you remove a credit facility or closing a credit card, in this example here, you're removing that actual transaction history off of your credit report. So really important that you basically review your credit report, and I'm going to give you access and some tips how to do that later in the presentation here. But in reviewing your credit report, you can see and determine, what is the length of history that is showing on your credit report. You can make sure that then you're selecting the correct accounts to close. And when you're looking at closing a credit card down, you basically want to make sure that you have something that's already replaced that transaction history. So if it's a card you're not using, you don't want to close it down right now. You probably want to keep it open for another few years until the new credit card that you're utilizing has built up that transaction record. So if that's an example and that credit card you're not using, at least use it a couple times, over a few months, to at least have it reporting with a balance and that it is being used and that it has a low utilization on that card. And that's going to help continuing to build your credit as you then use and continue to use your primary card. You're building up more and more of a transaction time length on that. So really take note before you close any cards that you're kind of reviewing your credit report, seeing how long that transaction history is. And most importantly, we're keeping our accounts active. If you have a credit card that you're not utilizing at all, sometimes it is possible that your financial institution can close that down because of non-activity. And then if it is closed, then that transaction history is being removed off of your credit report. So definitely look to keep all your accounts active, just with a couple transactions through them if they're not being utilized. So it is producing an outstanding balance on your statement, and then you are paying it off in full. So our next one here in regards to strengthening our credit over time is having different types of credit accounts. And basically in this situation, there are two different types of credit out there. There's revolving credit and there's installment credit. And this is really important when we're looking at kind of your credit report and your overall financial health and kind of going back to your budgeting here. Are you able to budget a revolving credit payment, which can be determined in regards to how much you're utilizing there? A great example here is a credit card or a line of credit. That outstanding balance at the end of the month, we don't know until you utilize it over the month. So really coming into your budgeting here. Compared to installment credit, This basically is a fixed term loan with a fixed term monthly payment. So we're looking at both of these in regards to how you're managing your finances, how you're managing your monthly payments here. And it really demonstrates the ability to handle two different types of loans here. One that can be variable, and we don't know what that outstanding balance is going to be based on our purchases, but we have a good idea of managing what our purchases are, as well as basically how much money we have to pay that bill. And then, of course, a fixed term loan, typically like a personal loan, an auto loan, a student loan. These are all great examples that have specific terms anywhere between 1, 5, 7 years, and will have a fixed monthly payment over that time. And once you complete that term, basically that debt is completely paid off. So really having the different types of accounts, and we're starting all off typically with a few credit cards right off the bat. But as we continue through the different life cycles here, we're going to be adding more installment loans on here. First off, installment loans, typically student loans, but then we may look to refinance those down the road, giving us another loan on our credit report. We're looking at auto loans in this neighborhood as well. We're looking at debt consolidation loans here. You're looking at home loans. All different types of loans that will have a fixed monthly payment as well as a term for yourself. So really important to kind of have that different mix there, because it really demonstrates your ability to handle credit wisely. And I've just kind of gone through those examples here of regards to what types of accounts you should have in regards to revolving credit, really noting a credit card and a line of credit. And installment loans, we're looking at, the auto loans, personal loans, home loans, and secured loans out there. So lots of great options across the board. And I should note as well, if you do run into difficulty, receiving a loan out there, your option is basically kind of a secured route. Typically when you start off, and I'll focus here as everybody is majority students here. Obviously, you're going to school, you don't have a job, you don't have established credit here. That's something that's going to happen afterwards. But we really want to focus on that right off the bat. And your best option is basically a student credit card that will give you the ability from a financial institution to kind of get yourself started there. That's going to have an easier criteria than most regular credit cards, because in those criterias for approval, they're looking for income and they're looking for established credit already. So that student credit card is that great start right off the bat. They'll provide you with probably a lower limit here, but you can look to build that over time and you can utilize that. If you run into, credit difficulties there, you can look to get a secured credit card or a secured loan. This is you putting up cash security for those limits. And then basically, once you've utilized that over a specific time period, if it's unsecured, they can look to drop that cash security. If it's been fully secured against a loan, once you pay that loan off, you're provided that cash security back. So that can be another item if you run into trouble in regards to receiving and getting approved for any credit there. And our last one here that I want to focus on here is making sure that we're not applying for too many loans at once. It's really important to think about this anytime we're applying for any credit facility there. That's a credit card, that's a student loan, that's any type of loan out there. Basically, we are providing authorization to get our credit reports pulled. And all of those authorizations are directly on your credit report, and you'll be able to see that. And that's one of the items that we look at when you're applying for a loan is how many times have you had your credit report pulled? Are you continuously going to financial institutions and applying for a loan and continually looking for credit, which you may need or may not need as a situation? And really, if you're continually having your credit pulled and continually receiving credit, it really just shows kind of a mismanagement of credit and not utilizing it responsibly. So what we really suggest and what we want you to do is take advantage of shopping for your specific interest rates and not just applying to one specific institution. You want to apply to a multitude of institutions. But what you want to do in regards to your shopping here is basically do all your applications within a 2-week window here. In doing that all within 2 weeks, it's only going to count as one hard credit pull and one hard inquiry on your credit report. which is the key here. If you were continuing to go, week after week after week, month after month, and a great example is kind of car shopping, going to a dealership kind of every few weeks, getting your credit report pulled, that's going to actually be kind of more have a negative impact on your credit report because your credit is being continually pulled and it will always kind of pull your credit score down over time. And if you continue this behavior, it's just going to continue pulling your credit score down. So really the credit bureaus mentioned to focus on do your shopping within a 2 to 3 week window. It will just count as one credit pull in regards to getting all your quotes provided, and then you select the best option that's going to work for yourself. So, really take note of that. You must provide authorization, whether you're checking a box for online applications or on a written document. You must provide your authorization to for a financial institution to receive your credit report. If you don't, this is something you would want to be aware of, and you can take note of on your credit reports to protect yourself against any fraud or scams that could be occurring in regards to your personal information here. So, our 5 tips that we've kind of focused on here today to improve your credit score is we want to make sure that we're paying our bills on time. That's the most important bucket of strengthening our credit. That's over 35% of the total percentage that's coming into building that credit score. We want to make sure we're keeping our credit card balances low and that utilization within 30%. That's that second key bucket of about 30% going towards your credit score. Making sure that we're closing and reviewing when we close any accounts because we're fully aware that we're removing that transaction history off of our credit report, and removing that history can cause a negative swing in our credit score. We want to make sure we're having different types of accounts, that revolving account and installment accounts, showing that we're managing our credit responsibly, that we have a budget in place to make sure that we can make these payments in regards to both loans. And then our last one, making sure that we're not opening up too many accounts all at one time and getting our credit reports pulled in regards to any loan facilities that you're looking out there, and truly doing your shopping in regards to any loans that you're looking for within that 2 to 3 week window there. So these 5 tips right off the bat are really going to help you strengthen and build your credit score over time. I really advise all USC students to just truly focus on the first two: pay your bills on time and keep that utilization low. That really, while you're going to school here, is going to make a huge impact in regards to strengthening your credit over time. And then as you start jumping into the next life cycles, you're going to be bringing on new loans with a new job, higher income, and it will just go and go from there, continuing to build your financial health. So, some great information that we have here to provide you is in regards to protecting and accessing your credit reports now here. And wanted to provide you with 2 great options that you have available through the 3 credit bureaus, and that's Equifax, Experian, and TransUnion. And the first one that you can do is set up an extended fraud alert. This is a really great feature here that most people utilize. This is where you're actually putting an alert directly on your credit report, in which basically any individual that pulls that report will see that flagged on your report and must contact you at the number that you've provided on that report. So, really important to basically keep that telephone number up to date. And even more importantly, have it set up on your cell phone. I've actually been working with a member, previously a few years ago at a bank. They had that credit report, credit alert on their credit report. Well, they were sitting directly in front of me. They had all their documentation there. Was able to fully verify them. But when it came to that credit report, they had their telephone number set up there. And in effect, they had to go home, answer that telephone call, go through the verification again that I had, and then they could come back to me so that we could continue the application process there. So keep that information up to date. Be aware of it. This is a great tool because basically, anytime your credit report is being pulled, it's the financial institution's responsibility to verify you directly off of the telephone number on your credit report. This is going to last on your report for up to 7 years, and is probably the feature that most people utilize in regards to an alert on their credit report. Our next item here is a full credit freeze. This actually stops the credit report from coming into the financial institution altogether. So this is basically a full stop option here. So what you would need to do is basically before you are considering applying for a loan and submitting an application, or you can even submit the application. But what will happen is the institution is going to reach out to you and say, you know what, thank you for the application, except we couldn't receive your credit report. Can you please contact the 3 credit bureau agencies and remove that off of them? Now, it may depend. You may not have to contact all 3. It may just be 1 or 2, depending on who the financial institution is utilizing in regards to your credit score from the credit bureau. You're typically finding Experian is used the most, and then kind of Equifax second, TransUnion third. Sorry about that. Little allergies here today, but the voice is still going here. So credit freeze here is a really great option to utilize to basically stop that credit report from going to anybody. You basically contact the credit reports, pretty much suggest that, and they would comment as well that they lift that freeze off the report for basically a 3-week window so that you can submit any applications that you want to out into the marketplace to any financial institution. And then basically after that period, then it goes back into a full freeze and locks it down from there. Now, how do we access our credit report? As I've kind of gone through all this information, well, you have a fantastic resource here through annualcreditreport.com. This was set up by the federal government here. So this is your best source to accessing all 3 bureaus and your reports. You can access them directly themselves, but this is a great website to go through. We'll link directly to them. Most importantly, accessing your credit report through this website, it will not count as a inquiry or a hard credit pull on your credit report here. So really great option to do. What I suggest right off the bat is basically on kind of day 1, once you get this information, is pull the reports from all 3 bureaus right off the bat. Do a credit report self-audit on yourself. Review all your personal information because there can be mistakes in regards to names, date of births, and so forth. And you want to make sure that's corrected because as you go through a loan process, we'll need to make sure this information is correct and we'll have to correct it at that time. So, having this done beforehand by yourself will help speed up that process and make, most importantly, that all that information is correct for you. You can review the inquiries that have been done on your credit report there, which will show all the institutions which you've provided their credit access to. And then as well, which is a really great feature here, is you may not be even aware of any past due accounts or collection items that are directly on your credit report. So this will show any items on there, as well as hospital bills, anything that you may not be aware of that's gone to a collection agency. So great information here going to annualcreditreport.com. Do that credit report self-audit, see what information that the financial institutions are seeing about yourself, all your personal information. This is our risk report in regards to approving you for a loan and setting that interest rate there. So, when we look at the report, we're going through your personal information. We can see all the numerous addresses that you've lived over the last number of years, showing us, is that stability or is it not? We're able to see all of the inquiries that have occurred over the last number of years. So we can see, are you continually looking for credit, or is this basically you're managing that responsibly and doing, all your inquiries within a short period of time? And most importantly, if there's any items that you weren't even aware of, myself, this came up with parking tickets a number of years ago. Wasn't being responsible in regards to keeping in track of the statements they were mailing out to me. I was unfortunately just not paying attention to that. And that went to collections, and those parking tickets went on my credit report. Once I accessed my credit report, took note of that, then I made sure I cleared that up and got that off my report right away. So really great option. I really recommend it. Everybody go to annualcreditreport.com. pull all three credit bureaus at once, do a self audit. You're not going to receive your credit score here. And that's not really the key feature of this. We want to make sure we're doing an audit of all the information, being in control, seeing what our transaction history is, most importantly, on those credit facilities, seeing our credit cards and all of our loans on those reports, seeing if there's any late payments within that 30, 60, and 90 days, which is truly important there. So really great focus right off the bat, do all three. And then going forward year after year, what I really suggest, and most of the credit bureaus suggest, is get in the habit of pulling one report, on a quarterly basis. This now really puts you in the driver's seat of controlling kind of where your credit report is going. So you're taking note if you are a victim of any identity theft or scams, you'll be able to see that on your credit report because you're looking to see if anybody has pulled your credit without your authorization or any items are appearing on your credit report which you have no idea about. And most people actually don't know about these issues until they approach a financial institution and apply, for a credit card or an additional loan. That's typically an auto loan, credit card. Those are the most frequent types of applications that are seen kind of on a continuous basis through someone's life. So really want to be able to jump ahead of that instead of walking into a financial institution and then asking you all these questions about something you have no idea about. Putting you in control of your own credit report allows you to be in the driver's seat here to identify anything that pops up that shouldn't be. And unfortunately, with just the information out there these days, that the hacking ability, unfortunately, it's not a matter of if you're going to be hacked and your personal information is going to be exposed. It will unfortunately just be a matter of when that is going to occur. So you want to be in the driver's seat to make sure that you do have that protection on your credit report, such as an extended credit freeze or the full the extended. Let's go back to that slide in a second here. Oh, I've just lost. Where'd it go? Oh, there we go. Perfect. The extended fraud alert or the credit free. So putting these two factors in place is really important, as well as reviewing your credit score over time. So with that and kind of rounding out the presentation here, wanted to provide you with some great financial wellness tools that we have available for you, all completely fee-free directly through the USC Credit Union for you. We have a great learning lab. We have a financial focus online module series there, which I'll provide a little bit more information on my next slide. We have all the information about our credit report review through annualcreditreport.com. We have debt management plans if you find yourself, starting to feel underwater in regards to debt, and what you can do working with a financial counselor to get yourself and to create a plan to get out of that debt. We have financial counselor services. We have student loan counseling services as well. So lots of great information. You can find that through the QR code as well as directly on the USC Credit Union site there for you, accessible for lots of great information. And my favorite within those series of them is our financial focus learning series. This is an online module-based learning system here in which there's a number of playlists set up. And within each playlist, there's probably about 10 different online modules, all ranging between, anywhere between 5 and 7 minutes, which you can access at your own time. Share this with your friends and family. Lots of great information, goes over the basics of financial products, all about your credit, all about financial resiliency and building yourself in a better position, the working world, investing in your future. So lots of great information here for you. And with that, we've kind of rounded out our presentation on mastering your credit and the 5 key items that you can do to focus on your credit score. So we'll open it up for any questions. I thank everybody for your attendance today, and we'll answer everything that we have available here for you.
Thank you, Ryan. Thank you so much for all of that information, and we will share all of those links after the workshop. So we have 20 minutes here to go over questions, and we'll try to cover as many as possible. The first question for you, Ryan, is from an alum. Do you recommend utilizing a credit repair company to improve credit? If so, how do you suggest about verifying the authenticity of a credit repair company?
Great question right off the bat. So I don't see a true need for a credit repair company. I see more of the need to have some financial counseling off the bat, because really what we need to focus on in regards to this is making our payments on time, keeping our utilization low, you know, consolidating any debt so that we make it easier on ourselves. So I think really the first step is, just approaching your financial institution, kind of just running through and doing a financial wellness check on basically the products that you're utilizing, what debt you're in, what utilization is it, because you may be better served in regards to having a debt consolidation loan compared to leaving debt on a credit card, paying a high interest rate, having a high utilization there. There's no fee for any of this stuff compared to a credit repair company could be having a fee there, and most importantly, not knowing the full validity of those companies out there. So I really stress, start first with your own financial institution. Also, one of the resources that we have through financial counseling on our wellness site, that's another great resource to have a first introductory conversation to think what you can do. And really, what you're looking at is how many existing credit facilities that you have. Are you making your payments on time? What's that utilization? And then looking to, do I need to bring on additional types of credit facilities on my report? Because really what we're looking for is about, 3 to 4 active credit facilities all at one moment in time. So that can be, anywhere between 1 to 3 credit cards. That could be anywhere between, a few different loans, a personal loan, a student loan. Now, a student loan isn't really going to provide you much until you start your repayment history. So in deferment, it's nice because it kind of goes on your report, but you're not kind of reaping the benefits of that until you go into a repayment system. And really, most credit repair companies are just providing you an additional loan to put on your credit report and adding that payment transaction record, which you can easily just, work with a financial institution in regards to getting, whether it's a small, credit builder loan that could be something, upwards of $1,000, and you can have a 1 year term and you have a fixed monthly payment and you can pay that off. Really, it's just, managing your credit responsibly and having those credit facilities. So I'm not going to really recommend any credit repair companies out there. I really stress, first going to your financial institution, having a review with them and seeing what options and solutions that they can provide for you.
Thank you, Ryan. We have a few questions about good to exceptional. So, how can I go from very good to exceptional without any loans? And then another question was, if you have a very good score, how can you move to exceptional? Can we see how our score is broken down into buckets to see what we're missing?
Perfect. Great questions there. So, first question in regards to how do I get to exceptional without having any loans? Well, you won't. You need to have credit in order to build credit. If you're not utilizing credit, you're not going to strengthen and build your credit score over time. So, really, to get to that exceptional, I'm talking and looking at basically, a 30-year lifelong journey of utilizing credit responsibly here in regards to all products, credit cards, loans, making sure that you have that mix of installment and revolving credit, all going back to you being able to utilize it and making your payments on time. So, in order to build credit, we need credit, regardless if we have the cash on hand. So, really important that basically, if we don't need credit, we're still getting it and we're utilizing it and making sure we're keeping that utilization to build it over time. Because, as I mentioned, it's not just a kind of, within a couple months, couple years. This is a lifelong journey of continuing to build our credit, getting up to that good and exceptional category. Now, the second question here of kind of how do we focus and moving in regards to good to exceptional? I'm not truly focused on kind of moving that number really over 740. That's my focus in maintaining it over 740 plus. To get into the 850s and higher, this is going to take a extremely long period of time because we're looking at that long-term longevity of your payment transaction history with multiple loans over time here. So our focus is to get to the good category and then just to maintain that behavior, and that will slowly continue getting us into the exceptional category. But my focus really is just to maintain above 740, 760 plus is absolutely key going forward. And we need to continue to bring on credit facilities over time to continue to strengthen our credit score. I'll go back to just this slide. Here we go. You know, the credit score breakdown. This is basically the key to everything. The first two, keep your payment history going, keep the utilization low. And then as we continue through our life cycle journeys here, we're extending our length of credit history every year. We're bringing on new types of credit mixes there, and we're bringing on new additional credit as we have those need for new loans there. So these 5 key items there are going to get us into the good and then move us into the exceptional category over a very long period of time.
Amazing, thank you. A student is asking, does using Zelle and online bill pay help build a credit score in any way?
Great question there. So actually, no, this will not help in any regards in regards to building your credit because Zelle is just a payment transaction system, much like utilizing your debit card or your bank account in regards to cash. All of these features here have nothing to do with credit. Credit is solely basically me lending you money and then utilizing that in a responsible fashion. So utilizing Zelle, utilizing your debit card isn't going to basically build your credit or even establish credit in any metric there. Really, the focus is having credit cards and having additional loan facilities such as a line of credit, a personal loan, an auto loan, a home loan, different features over time as you're going to have multiple loans over time. When I look at an individual, over probably 20 years of their life and looking at a credit score, I'm probably going to see at least, 5 to 7 car loans on there. I'm probably going to see a number of credit cards. I'm going to see a number of personal loans that went on the report for, a couple years and then were paid off in full. So it's this behavior that we're really looking for on your credit report to continue to drive and strengthen your credit report there. Great question in regards to that one.
Awesome, thank you. We have two questions from international students.
Mhm.
So, can and how international students with no Social Security accumulate credit score? And
Mhm.
another question is, I'm an international student and will start to work with OPT. If I need to buy a car and have two options buying with cash or installment, do you recommend using installment for my credit to be increased?
Okay, perfect. So starting on the first question there, really important, when we look at basically the credit system here, is there are some agencies out there that can report your credit history without a social security number. Whereas the majority of the financial system requires a social security number in order to report the information from their institution directly to the credit bureaus. So you want to take note right off the bat. Probably I would say at least 75 to 80, maybe even higher than that, of all credit cards out there, as well as loans, require a social security number so that they can report to the credit bureaus. We're starting to see a small amount of companies not requiring social security numbers in which they can say they can report to the credit bureau, but I really can't speak on that topic. I don't know enough about those companies. So we really focus and recommend for international students that they get a social security number. As being USC students, your best option there is to get an on-campus job. Once you get that, you'll get your social security number. With that, then you can utilize that to apply for basically, a credit card to start off, and that's going to be reporting to the credit bureau there. Our second question in regards to building credit, looking for an auto loan. Should I use cash or should I use a loan? Well, you know what? If you have the cash, it's always great. You can utilize that, but we're looking at, building our credit score here. So your best option here would be to have, in effect, an auto loan here. You could utilize that cash possibly depending on what the rates of returns are in the marketplace. You possibly could get a good rate of return in putting that in a cash deposit compared to what your auto loan rate is. So you definitely want to consider that, but you would want to at least probably have, if you have a lot of cash on hand, at least get yourself, a small loan for that car, because having that loan basically is going to put that on your credit report, is adding a new credit facility on there. It's showing that you're paying that over time until it's paid off, which is adding to your credit history, and it's adding your transaction length in that transaction history there, which is really key.
Awesome, thank you. Another question is there a recommended percentage bracket within which I should keep the line utilized? Is greater than 5% better, or 40 to 60%, or 80 to 90%?
Great question. Yeah. So this is our second bucket here on our credit score breakdown. That utilization, 30% of utilization is directed to your credit score. And that amount of utilization that we want to focus on is 30%. So if our credit card limit is $1,000, when our statement is produced, we want to be focused on that outstanding balance being around $300. And then from there, paying that off in full, and just having this continuous behavior month over month, year after year, showing that we're utilizing credit. We're keeping it at a low utilization of 30, because if you're, running it all the way up to that max balance, when I look at your credit report, I see, oh, you have a limit of $1,000, but you ran your credit card up to $800 or $900 or even $1,000 this month. Oh, it seems that you're very reliant on your credit card. If I actually took that away from you, how is your financial health? Where are the funds coming from? Are you just purchasing this directly on credit, or do you actually have the cash on hand to pay that bill off? So really important to focus on 30% utilization when your credit card statement is produced there, or a line of credit. Any revolving credit, you want to focus on 30% utilization. Great question.
Thank you. So there's several questions about the score. So why does it differ so much from TransUnion, Experian? And then why does my credit score sometimes go up and down by small numbers without reason? I always pay off my credit cards on time and do everything I can to keep my score up.
Absolutely. Great questions here. So, first off, these five buckets here that are determining your credit score breakdown: your payment history, your utilization, your length of credit history, your types of credit mix, and your new credit. All three credit bureaus, Equifax, Experian, and TransUnion, are utilizing these to determine based on this percentage, but they all have a different mathematical equation to determine what will be the final output of your credit score. So we're really not focused, directly on what is the specific number. Am I, 680? Am I 690? It's more within these categories here, looking to be within, 670 to basically 740, to being 740 to 800. This is the key, to be within these brackets and just, continually moving up from good, very good, and then finally into the exceptional. Most people really kind of bounce around, and I would say within the middle three here are fair, good, and very good. Now, your credit score constantly moves around, basically, whether it's going to be very little, or it's going to be a lot due to any behaviors and negative behaviors that are impacting your credit report there. So, anytime basically you get your credit report pulled, you're going to see a dip in your credit score just because it's being utilized, but it will pop back up typically within a 2-week period there. But if you were continuing to do behavior where you're continuing to get your credit report pulled, then it would just continually, slowly, keep going down, and it wouldn't bounce back up over that short period of time. Your utilization, all your debts are being reported on a monthly basis back to the credit bureau. So they're, slowly taking this information in, slowly adjusting those credit scores over time, changing always a little bit around there. All of them all have different credit criterias and are establishing that specific credit card, or credit number there across the board. I have a lot of people that, can come in and say, hey, I'm utilizing Credit Karma to give me an indication of where my credit score is. It says I'm at 740, but when I actually had my credit report pulled, my credit report was at 700. What's the major difference there? Well, first off, you're getting your credit score, and there's different versions of credit score calculations out there, and everybody can be utilizing a different method in regards to it, but it's all going to be very similar. But getting back to kind of those third party systems like Credit Karma, these are not credit bureaus. They're kind of indicating their own credit number system there and providing it to you really more just to give you kind of a point of where you're going and where you're trending. So you never want to put your full faith in regards to kind of a third party system that's providing you your credit score. Your best option is basically directly through the credit bureaus, Equifax, Experian, and TransUnion. And most importantly, these days, most financial institutions are providing you a link directly to one of those agencies there and providing you that through their online banking systems. And typically that's kind of on a quarterly basis that they're updating those numbers there. So that's probably your best bet in regards to just viewing where you're at. You can also always approach, specifically the three credit bureaus directly and pay for your credit score. You're probably looking around, I believe it's around $15 there. And just noting, where we typically are on the West Coast here, you would probably want to focus on your Experian credit score because that's the one that's utilized most on the West Coast from financial institutions. More on the East Coast and middle, we're typically seeing Equifax, and TransUnion is utilized on a much smaller basis. Now, depending on your financial institution and what type of loan you're applying for, they may just be utilizing one score, or they may be pulling scores from all three to see what the difference and the variation is between those numbers, and then selecting, kind of dropping off the high and the low and utilizing a medium score in regards to that position. Great question.
Yeah, great questions. So we have time for a few more. This is an interesting question about opening credit cards. So sometimes to get discounts on purchases, I open credit cards at random stores, Best Buy, Macy's, etc. Then use the card for the first time payment there and never really again. This has hurt my credit. If I do this a lot, I'm paying the purchase on time, just opening up new cards to get the discount. And then a follow-up question, I think another student is asking a very similar question, like how many credit cards do you recommend having at once?
This is a great question. Glad it was really brought up because I had a friend I was speaking with a couple years ago, knowing I was in the financial institution world here, and being able to approve loans and so forth. And he said, I'm really doing a great job with my credit. Look at how many credit cards and store cards I have. And he had about 10 to 15. And I said, well, actually, that's exactly what I don't want to see from somebody. That is not utilizing credit responsibly. Why do you need access to that amount of credit? And store cards can really be a key item here in regards to this conversation because, as the question person noted here, I signed up for this credit card, I used it for this one-time discount, and then I really never utilized it again. You're basically signing up for credit, which is causing a dip in your credit score, and then you're not continually utilizing that card and creating that long track period of payment transaction history, because typically you can only utilize it at that store pretty much in most cases there. So there's great incentives from all these credit card companies and stores for us to spend, and that incentive is, hey, there's a discount, hey, there's a reward. But we kind of have to step back from that and go, is that discount or is that reward worth it in regards to managing our credit responsibly and providing ourselves the best financial health that we can possibly do? So kind of working into the second question there is, how many credit cards should I really have? You know what, you should probably be looking probably no more between probably 3 to 4 if you're popping in some store cards there. And if you are utilizing store cards, making sure that you're actually using them continuously to continue to create a payment transaction history. If it's a one-shot deal, as that person in the first question noted, their score came down a little bit, they made that purchase, and then that credit card, that store card, pretty much becomes inactive. There's no transaction balance history being reported to the credit bureau, which is showing utilization, which is showing activity across the board there. So myself, I really stress to say, in regards to credit cards, probably no more than 2 or 3. Myself, I kind of have two. I utilize a primary card and I have a backup card. I don't need additional access to credit. I don't need access to, $10,000 worth of unsecured credit. I need access to a certain amount in which I feel comfortable with. And that's the key. And then basically making sure I'm utilizing it correctly at that low utilization and I'm paying my bill off in full on a monthly basis. Or if I can't, I'm making sure I'm paying as much as I can and then getting caught up and paying that off, the next month or the month after that, making sure that that's not, over the long term. And if it is, then I would want to look to see if there's possibly a debt consolidation loan that I could move that debt into, because we really want to make sure is we are not holding debt on credit cards. That interest rate is just phenomenal. Most, credit cards upwards of 23 to 30% interest on that debt on that credit card. Comparing if you were to pull that off, put that in a debt consolidation loan with a fixed term, with a fixed monthly payment to provide you a solution and a payoff schedule for that, you're looking at an interest rate probably between 10 and 15%. So really make sure that you're utilizing credit responsibly. Having good credit doesn't mean that you have access to, $100,000 worth of unsecured credit. It means that you have responsible credit limits and that you're utilizing the credit. You just don't have it and are never utilizing it. That's not going to do you any good. And that's, what a lot of the store cards fall into these categories, because you're just utilizing it for a purchase here and there, or just that introductory purchase. And then really have to know, I had a friend that did this and there was an introductory offer for 6 months. Well, when that 6 months came up, so much time period had gone past, he forgot that that payment was required at the end of 6 months. And therefore he missed it. That late payment went on his report. He was charged a huge amount of interest. So you really want to make sure, you have what you need and you're utilizing it responsibly. Some fantastic questions.
Hey, thank you, Ryan. So we are at time. I do also see a lot of more questions, but unfortunately we are at time. So if you still want to ask these questions to Ryan, how can they reach you, Ryan?
Absolutely. So what I'll do, Sarah, is I'll provide you with my contact information and basically just fire questions away. We also have a great resource in regards to our branch network on campus. We have our uh, student union branch right next to the career center, just right on the other corner of the building there. So my staff is there to fully assist you in regards to help answering any questions. We also have a branch over in the village next to Trader Joe's and Amazon there. So two great points, but I'll provide Sarah with all my contact information and you can ask me any questions and we'll help and assist you from there.
Awesome. Thank you. And then just as a closing, I just wanted to share a few announcements. We do have a few more webinars scheduled. So sustainability and impact investing will be from 5 to 6 Pacific time virtually. And side hustles, building wealth to multiple sources of income will be from 7 to 8, also virtually. So please continue to join us for those sessions. And then last but not least, please fill out our post-session survey. Once you give your feedback, you'll be entered into an opportunity drawing for a $50 Amazon gift card or Apple AirPods. If you have questions about our conference, as always, please email careers@usc.edu or myself at sarah@usc.edu. Thank you again for joining. And Ryan, we appreciate your partnership over these years.
Awesome. Thank you so much, Sarah. Thanks, everybody. Some great questions. Thank you much for participating. And everybody's on their way to a strengthening and great building of their credit over time here.
Awesome. Fight on.
Fantastic. Fight on, everybody. Thank you.